Sarah opened her email last Tuesday and found a letter that will change the next 30 years of her life. She almost deleted it. It looked like spam, government formatting, no subject line that mattered. But buried in paragraph 3 was a sentence that's about to hit 40 million Americans. Your repayment plan is being eliminated. My name is Jack, and the government just rewrote the rules on student debt to save $409 billion. Nobody explained where that money is actually coming from. Stick around, because by the end of this video, you'll know exactly what that letter means for your wallet and exactly what decision you have 90 days to make before it's made for you. Sarah is 34. She teaches middle school in Ohio. She borrowed $61,000 for her degree. For the last 2 years, her payments were calculated under a plan called SAVE. It capped her payment based on her income. It paused interest when she couldn't afford to pay. It was, by every measure, the most generous repayment plan the federal government has ever offered. That plan is dead now. Not paused, not under review, dead. And Sarah has 90 days to pick a replacement, or the government will pick one for her. Here's the thing nobody told Sarah. Whatever she picks in the next 90 days, she's stuck with. There's no changing your mind later. One choice, 30 years of consequences. Let's rewind, because you need to understand how we got here. For the last 25 years, the federal government ran a maze of income-driven repayment plans: PAE, ICR, IBR, SAVE. Each one had different rules, different formulas, different forgiveness timelines. Confusing on purpose? Maybe. Confusing in practice? Absolutely. Then, in July of 2025, Congress passed a law called the One Big Beautiful Bill Act. Inside it was a complete demolition of that maze. 3 plans, gone, replaced by exactly one. It's called the Repayment Assistance Plan, RAP for short. The government says this saves taxpayers $409 billion over the next decade. That number is real. It's also incomplete, because $409 billion doesn't appear out of nowhere. It comes from somewhere, and that somewhere is the monthly payment of every single person reading that letter Sarah got. Quick gut check before we go further. This isn't financial advice. I'm not your advisor. This is the mechanics laid out clearly so you can make your own call. Okay, back to the machine. Here's the new plan stripped of the jargon. Under RAP, your monthly payment is a percentage of your income, somewhere between 1 and 10%. Sounds simple. Here's where it gets sharp. There is no $0 payment, ever. Under the old SAVE plan, if you earn too little, your payment could legally be $0 a month. Under RAP, the absolute floor is $10 a month, even if you're unemployed, even if you're in school. $10 every month for 30 years, no exceptions. And there's no ceiling either. Old plans like IBR capped your payment at whatever the standard 10-year plan would have cost you. RAP has no cap. As your income grows, your payment keeps climbing with it, forever. There's no point where you've paid enough and the formula stops squeezing. And here's a detail that should genuinely bother you. Forgiveness used to come after 20 to 25 years on these income plans. Under RAP, it's 30 years, 5 extra years of payments minimum baked directly into the replacement plan. Now here's the part that turns this into a trap instead of just a rule change. Once you enroll in RAP, you cannot switch back to a different plan. Not next year, not if your income drops, not if you find a better option. One door, it locks behind you. Compare that to Sarah's old SAVE plan where adjusting was at least possible. RAP removes that flexibility entirely. You are betting on RAP being right for your entire financial future the moment you sign up, with no way to undo it. Here's why this matters to you specifically right now. July 1st, 2026, the SAVE plan officially ends. If you're one of millions of borrowers still sitting in that plan, your servicer is required to notify you. You then get 90 days to choose a new plan yourself. 90 days. If you don't choose, the government chooses for you. And the default option they pick isn't RAP. It's the new standard repayment plan. Fixed monthly payments, no income adjustment, calculated purely on your balance. For someone with a low income and a large balance, that default option could mean a payment 3 or 4 times higher than what they were paying under Save. This is the part of these breakdowns I get asked about constantly. How do you actually track changes like this as they happen, before they show up in a scary headline? That's genuinely the whole reason this channel exists. If a deep dive like this is useful to you, subscribing helps more than you'd think, since it tells me to keep making them. If this is connecting dots for you right now, hit that like button. It costs nothing, and it tells the algorithm that people actually want to understand this stuff instead of just being scared by headlines about it. Okay, let's get into who this actually hurts the most and what the smart move looks like. Picture 2 borrowers. Marcus, a nurse making $48,000 a year with $40,000 in debt, and Elena, a software engineer making $130,000 a year with the same $40,000 in debt. Under the old IBR plan, Marcus's payment was capped low because of his income, and once he hit the cap, it never grew no matter what. With RAP, Marcus's $10 a month floor protects him while he's struggling, but the moment his income rises even slightly, his payment rises with it, with no ceiling, for 30 years. Elena, on the other hand, actually does better under certain RAP scenarios than she would have under Save, because the formula uses adjusted gross income rather than the older discretionary income calculation, which can work in favor of higher earners in specific income bands. The uncomfortable truth here, this rule change doesn't hit everyone the same way. It can quietly help some high earners while extending the financial runway of lower earners by years. Zoom out for a second, because this fits into something much larger than one repayment plan. Right now, federal student debt sits at $1.7 trillion. Over 9 million borrowers are already in default. Roughly 1 new borrower defaults every 8 seconds. The Department of Education has been quietly shrinking, and collection authority is being handed over to the Treasury Department, the same agency that garnishes tax refunds and Social Security checks. That $409 billion in savings isn't abstract. It's the government restructuring the entire machine, betting that locking people into longer, less flexible payment plans with no $0 floor and no payment ceiling recovers more money over time than the old patchwork of plans ever did. Whether that's good policy or bad policy depends entirely on which side of the formula you're standing on. I'm not here to tell you which side is right. I'm here to make sure you know which side you're on before you sign anything. So here's the practical part. If you're currently on Save or any of the soon-to-be eliminated plans, here's the move. First, do not wait for the default. The standard repayment plan that kicks in automatically is, for most lower and middle-income borrowers, the most expensive possible outcome. Choosing nothing is itself a choice, and it's usually the worst one. Second, run the actual numbers before enrolling in RAP. Because RAP locks you in permanently, this is not a decision to make quickly. If your income is rising or you expect it to rise significantly, model out what your payment looks like in 5 years, not just today. Third, know your forgiveness timeline either way. 30 years under RAP is a long time to be tied to a single number. Understanding exactly when, if ever, you'll see forgiveness matters more under this plan than any plan before it, because the formula no longer caps your downside the way old plans did. Here's what I want you to actually walk away with. The government didn't hide this $409 billion. They put out a press release about it. What they didn't do is explain it in the one place that actually matters. Your kitchen table, looking at your own loan balance, trying to figure out what changes for you specifically. Sarah, the teacher from the beginning of this video, almost deleted that email. She didn't understand why she should care. Now you do. 40 million borrowers are getting some version of that same letter. The only question left is whether you're one of the people who reads paragraph 3 and understands exactly what it means, or one of the people who finds out the hard way, 90 days too late. If this finally made the rule change make sense, subscribe, because the next video in this series goes even deeper into the homeowner side of the 2008 parallel. What happens when millions of Americans start tapping their home equity at the exact same moment this debt crisis peaks? That one connects directly to what we just covered. I'll see you in the next one.